Hello! A viewer of the channel asked to make a video about Adobe, and it's a very interesting company that has been growing higher and higher, yet again affected, like pretty much all companies or the vast majority, from the recent downturn. Used to be at around $700 here, and it's now back to 457. And we can kind of see that it has lost quite a lot in the last 3 months, but we want to examine the company as usual, see what's happening with their financials and whether it's a potentially interesting buy for us here. And at the end of the video, we're going to also be using a DCF model in order to understand what kind of valuation and what kind of money we should be willing to pay for a company like Adobe right now. So first things first, let's start off with the outstanding shares, which are sitting at 471 million here. And this kind of picture is something that I love to see, obviously, because this means that the company is buying back shares. And they were actually buying back shares even at these values here, which may be slightly expensive actually. But still, they are rewarding investors by buying back shares, and now those people who actually had shares, the investors who previously had shares, could see and will likely see their shares increasing in value eventually. And I'm assuming that they're going to continue buying, and this is the current trend right now, and especially if the price of the stock goes down, maybe they will keep buying. Now, the financials of the company is the next thing that we're going to be examining. And we will start off by taking a look at the income statement of the company. You will see here that the company is enjoying an about 20% year-over-year growth every year, really, in the revenues, and that's nice because we can use it for our projections. It's much easier to project when you have predictable values here. And same with gross profit, also increasing nicely. The net income of the company from 1.7 billion in 2017 to now being about 5 billion. So there is a big increase here, almost 3 times as much from 2017. The company seems to be doing very well. What about the balance sheet here? The balance sheet of the company is showing us that the total assets of the company are sitting at 27 billion over here. And the important thing, the total liabilities are 12 billion. So 27 billion in assets and 12 billion in liabilities. It's like more than double assets than liabilities, which is good. The total equity is 15 million actually, meaning if you exclude liabilities from the equity. The cash flow, the most important thing. Cash from operations also increasing very nicely, and from 3 billion went to 7.2 billion. And the company seems to be doing very well with free cash flow also. I was examining it earlier, and 2017 they were sitting at 2.7 billion, and now it's almost 7 billion. That's a steep increase here, and that's very good to see. And later on we're gonna examine exactly what kind of growth this is and how to use it for our projections. The multiples of the company seem to be increasing though, and that points to a little bit of an overvalued company based on the amount of sales that they're making. And potentially with this kind of price, you would expect that. Profitability is great. It's at 35%, which is really awesome. It means that your return on equity is going to be good with this company. Very good, actually. Very high. And the solvency, not much debt for the company. But the good thing is that they are not actually issuing shares. And so they are not gaining equity out of investors, but basically out of the money that they make. So that's good. No real issues with debt for the company, really. And now we're gonna be taking a little bit of a closer look at the actual discounted cash flow model and see how we can use that to determine what's a good price to pay for the company. And this is the Adobe DCF model that I have created. And you will see here that the values from free cash flow are pasted from year 1 to year 5. I did this earlier so that you don't have to wait. Plus the outstanding shares are sitting at 471 million right now. As you can see over here, we saw it earlier, it's 471.7. So, what we need to be determining now. The 5-year average free cash flow growth, as you can see here, is about 26%. We obviously don't want to use that for our projections because we're projecting in 10 years. And so we want to be much more conservative than this. So we're going to go with 13%, which I think is fair. It's like half of that. The discount rate is gonna be, we can use maybe 13% is fine. We want something that's above 10, obviously, because you can get that 10% out of an S&P 500 ETF. So let's say 13% is fair here. And a perpetual growth rate for the economy, let's give it a 1%, because the company can never outgrow the economy in growth in perpetuity. And so 1% is less than that, and it's probably fair for the company's growth in perpetuity. So what we're seeing here is that the model automatically projects into the future, 10 years into the future, plus adds the terminal value for what the company is worth after these 10 years. And after the discounted cash flow comes back to present value, and you will see these are the same here. This happens because the discount rate as the free cash flow growth that we are using is the same. So they basically cancel themselves out. Very, very normal, because the discount rate and the compound interest are inverse. They have an inverse relation, so they cancel themselves out. So that's to be expected. And the total value that we're getting for the company in perpetuity is about 127 billion here, and the price per share to pay if we do the division is 269 over here dollars per share. Now currently the company is sitting at 457, so it's almost twice as much as we would want to get it in order to to sustain this kind of growth that we wanted here and make this kind of money. So how would we reach like 470? I can give you an example. We would probably have to have a higher growth here, like maybe 20%, and then discount for, let's say, 11%. Or let's do it 12%. You can see how that changes. So now we're actually at where we would want to be today, 484. Actually, a little bit less than that is the current price. So we could potentially even get 13%. Yeah. So in order for us to for us to make sense to buy at this price, really, or close to it, 430 is what it is here, we'd have to account and think that the company will be growing at 20% a year for the next 10 years. This is how we're gonna be making enough free cash flow to for our purchase to make sense today in terms of the market price of the stock. That's what it is, right? So, and that would make us 13% a year if that scenario plays out. Now, I don't want to use this kind of free cash flow. I think it's very, very optimistic. I don't think it's going to happen for 10 years. It could happen for 5 years, but I don't think it's going to happen for 10. And I'd probably want to use something that's closer to 10%, really. Or, as I showed you earlier, 13%. It's probably makes much more sense. So, currently, the company is a little bit overpriced for me. I love it. I love the company. The company is doing great. It's making a lot of money. But I'll have to wait for it to go down a little bit, if it ever goes down, in order to get a better value for my money, because that's what investing is. I mean, the company may be great, but I'm not willing to buy it at any price. And you could kind of expect that it is overvalued. I mean, you can see how fast it has moved over here. I would expect it to be much more overvalued. It's not. It's not that overvalued when you compare it to some other companies, but still it is pretty overvalued. So we want to get it at about this level over here, ideally. So people who bought here were probably the lucky ones. So hope that helps you a little bit and you enjoyed the video. If you did, please leave a like, because that really helps the channel grow and bring the video to more people. And please subscribe as well, because I'd love to see you around. There's a lot of things going on with the channel, software as well that's going to be exclusive for you. And you can also join our Discord channel. You can view a link in the description box below and just click and join us. In the meantime, take a look at this video that I made earlier, and it's about Facebook, discussing the latest news. Thank you for watching, and I'll see you soon. Bye-bye.